There's this specific kind of disconnect you get when you look at the stock market sometimes.
Mm.
You see a company that is, fundamentally rewriting its own DNA. They're pivoting into high-margin tech, building data centers, deploying autonomous AI.
Right.
And yet the market is pricing it like it's 1990 and they're just drilling holes in the mud.
It's the legacy trap. The market sees the name SLB, formerly Schlumberger, and just thinks, big oil.
Yeah.
But if you actually dig into the stack of reports we have today, the January 2026 earnings, the Evercore analysis, those deep dives from Seeking Alpha, you realize that label is, well, it's about a decade out of date.
That is exactly the disconnect we are here to explore. We're diving into SLB, the world's biggest oil field services company, sure.
Yes.
But the mission today is to figure out if they're actually pulling off one of the biggest industrial pivots in history. Are they becoming a global technology and data powerhouse? Or is that just, corporate marketing?
I think it's a bit of both, but the tech powerhouse claim has surprisingly real teeth. The whole narrative arc here is what some analysts are calling the Red Queen effect. You know the reference.
Alice in Wonderland. You have to run as fast as you can just to stay in the same place.
Exactly. In the energy sector, if SLB just kept drilling wells, they'd eventually shrink. The energy transition is real.
Sure.
So they aren't just running. They're trying to change the racetrack entirely. They're using the massive cash flow from the old world to fund a high-tech infrastructure for the new one.
So let's look at that old world cash engine first, because to understand where they're going, we have to understand the shift and how they make money right now.
Okay.
I was struck by the distinction the reports made between CapEx and OpEx. It feels like the fundamental business model is flipping.
It is, and this is crucial for an investor to get. Historically, SLB lived and died by capital expenditure. That's an oil company saying, here's $50 million.
Go drill me a new hole. And when oil prices crash, that money just vanishes.
Instantly. It's boom and bust.
The whole wildcatting model. You eat what you kill.
Exactly. But now look at the 2025 full-year revenue breakdown. The biggest division at SLB is no longer well construction.
Okay.
It's production systems, bringing in $13.3 billion. And production systems is OpEx operational expenditure. It's the money companies spend just to keep existing wells flowing.
So wait, CapEx is buying the new car. OpEx is the maintenance, the tires, the gas.
Perfect analogy.
You can put off buying the new car, but you can't stop buying gas if you want to get to work.
That's it. By shifting the company's weight toward production, SLB is insulating itself from the volatility of oil prices.
Right.
Even if exploration stops tomorrow, the world still needs the oil from wells that already exist. SLB is positioning itself to be the caretaker of those assets.
And this explains the ChampionX acquisition. Because when I first saw that headline, $4.9 billion, all-stock deal, just thought, okay, big oil buying smaller oil, standard stuff.
Yeah, the usual playbook.
But in this context, it feels more like a defensive fortification.
It's a stability move, absolutely. ChampionX specializes in production chemicals and artificial lift.
Artificial lift. It sounds like something from a sci-fi pitch. What does that actually look like in the field?
It's actually pretty tangible. When you drill a well, usually the pressure is high enough that the oil just comes up on its own.
Right.
But eventually the reservoir gets tired, the pressure drops. You need help to drag that resource to the surface. That's artificial lift, electric submersible pumps, gas lift systems, things like that.
So it's basically life support for aging wells.
Precisely.
Yeah.
And considering a huge chunk of the world's easy oil is already gone, most wells are essentially on life support. By buying ChampionX, SLB is saying, we don't just want to be the midwife at the birth of the well, we want to be the doctor getting paid every month to keep the patient alive for 30 years.
And the numbers on this deal are interesting, too. They're not just buying revenue, they're buying efficiency. The sources mention $400 million in synergies.
Right. And they expect to hit half of that, so 50% of that synergy target by the end of 2026. That's aggressive.
Very.
It cements their grip on that production and recovery phase.
Yeah.
It makes them stickier. It's much harder for an oil company to fire the guy who manages your daily chemical injections than the guy who just drills a hole once and leaves.
Sticky revenue is the best revenue. But there's another layer of defense here, and that's geography. I was reading the Evercore report, and they were bullish on SLB, but actually downgraded Halliburton. And the difference seemed to be entirely about where they operate on the map.
It's their international moat. If you look at the North American land market, we're talking U.S. shale, basically. It is hyper-competitive, lower margin, and frankly, it's slowing down.
It's a crowded space.
Very. Halliburton is heavily exposed there. SLB 82% of their revenue comes from international markets.
82%. That barely makes them a U.S. company in terms of where the cash comes from.
Effectively, they aren't. They're a global entity. And the international market just behaves differently. It's driven by long-cycle projects. Think deepwater Brazil, offshore Guyana, or the massive expansion in the Middle East.
These are projects where you can't just turn off the tap because the price of oil dropped $5.
Precisely. Once you commit billions to a deepwater platform, you finish it. The planning horizon is decades, not quarters. The reports highlight a V-shaped recovery forecast for Saudi Arabia in 2026.
I saw that.
Rig counts are expected to bounce right back to early 2025 levels.
And what about on the ocean floor? The data mentioned a spike in subsea trees.
Yes, subsea trees. They're these massive, really complex valve assemblies that sit on the wellhead at the bottom of the ocean. They control the flow.
Okay.
SLB expects over 500 of these to be awarded across 2026 and 2027. That's a 20% increase.
And you don't buy a subsea tree at Home Depot. That is high-tech, high-cost, high-barrier-to-entry engineering.
Exactly. SLB is the king of the hill in that complex international environment. So while the U.S. frackers are tapping the brakes, SLB's international engine is just revving up.
Okay, so they have a fortress of cash flow built on international production. That's the safety net. But that's not why we're calling this a tech pivot. That's just smart traditional business. We need to talk about the digital division because the margins there are, well, they're software margins, not hardware margins.
They really are. The digital division brought in $2.7 billion in revenue. Now, compared to the hardware side, that might look small.
Sure.
But look at the profitability. 35% EBITDA margins.
That is massive.
It is. And more importantly, they broke the $1 billion barrier for annual recurring revenue, or AR, in 2025. And that's growing 15% year over year.
That's the magic metric. Wall Street loves ARR because it's predictable. It's the Netflix model versus the movie ticket model. But what are they actually selling?
Good question.
I think most people hear digital oil field and they think of an iPad and a truck, maybe a slightly better spreadsheet.
It's moved way, way beyond that.
Yeah.
The sources focus heavily on something called Agentic AI, and this is a really important distinction for you to grasp.
Agentic, so it has agency. It can do things on its own.
That's the leap. We're used to AI chatbots, where you look at a screen, you spot a problem, and then you have to go fix it.
Right.
SLB's new assistant, it's called Tela, is built on a loop. Observe, plan, generate, act, and learn.
Act is the scary word there. Or the exciting one.
Or the profitable one. Let's just break down a workflow. Imagine a drilling operation. Tela can observe the real-time data streaming up from the sensors.
Okay.
It might spot a pressure anomaly that a human would miss for another hour. It plans a correction, maybe adjusting mud weight or pump speed.
And it just does it.
In fully autonomous modes, yes, it can execute that optimization. It optimizes the equipment performance without a human having to micromanage every single step. It's autonomous efficiency.
So it's not just a dashboard, it's a co-pilot.
A co-pilot that never sleeps, never gets distracted, and processes data faster than any human engineer. And this all runs on their platform, Lumi.
And Lumi is the operating system for all this.
Think of it as the open architecture. It connects everything. And the big validation here isn't just the tech, it's the customer list. Shell just signed a massive agreement to use Lumi to unify their subsurface and weld the data.
I noted that in the press releases. That feels like the iPhone moment. Once a giant like Shell migrates their entire data brain into your ecosystem, they aren't leaving.
No way. The switching costs would be astronomical.
Exactly. It creates this incredibly high barrier to exit. And it changes the whole value proposition.
It does.
SLB isn't just renting you a drill bit anymore. They are selling you the efficiency of your entire organization. And that leads to this sort of aha moment I had reading this. Efficiency is the one thing you need in every market condition.
Right. In a downturn, low oil prices, you need efficiency just to survive, to lower your cost per barrel.
And in an upturn.
High prices, you need efficiency to drill faster and capture more profit. Digital wins in both markets.
That's a key insight. Hardware is cyclical, efficiency is secular. But speaking of efficiency, we have to talk about the part of the research that honestly just surprised me the most.
Let me guess. Data centers.
Yes. If you had told me SLB was a play on the AI data center boom, I would have assumed you were reading the wrong report.
It sounds like a buzzword grab, doesn't it?
Yeah.
Oh, we do AI too. Please buy our stock. But when you peel back the layers, it's actually a brilliant application of physics.
Physics. How do we get from mud pumps to server farms?
Well, think about what SLB has been doing for a century. They manage massive power loads and complex cooling systems for heavy machinery in the hottest, most hostile environments on Earth.
Right. A drilling rig in the Saudi desert is basically a giant heat management problem.
Exactly. Now, pivot to Silicon Valley. What is the biggest bottleneck for NVIDIA, Microsoft, all the hyperscalers right now?
Heat and power. The new AI chips are so powerful they're practically melting server racks, and the grid can't supply enough juice.
So SLB took their industrial cooling, tech liquid cooling heat exchange
Right.
and pivoted it into what they call modular data center solutions. These are prefab, liquid-cooled server units.
And the growth numbers on this are just staggering.
Explosive. The business grew 121% year over year in 2025.
121% growth for a massive industrial giant is almost unheard of. That's startup speed.
And their guidance is even wilder. They expect to exit 2026 with a $1 billion annual revenue run rate in this segment.
Wow.
2 years ago, this business barely existed. Now it's on track to be a billion-dollar unicorn inside the company.
But they're not just building the cool boxes, are they? They're trying to solve the power side of it, too. Because building a data center is easy, plugging it in is hard.
This is the other half of their new energy play. They have a partnership with Ormat Technologies to use enhanced geothermal systems, or EGS.
Oh, thermal, earth heat.
Which requires drilling holes, deep, complex, high-pressure holes. Who's better at that than SLB?
Right.
The vision is to pair these modular data centers with on-site geothermal power.
That solves the intermittency problem. Solar and wind turn off. The Earth stays hot 247.
Correct. If they can pull this off, they provide baseload, clean power to the data centers. It's a complete ecosystem play that bypasses the strained electrical grid entirely. It turns their legacy skill set drilling and cooling into a pure tech infrastructure play.
That is actually incredibly smart. It's not a pivot away from their skills. It's a pivot of where they apply them.
It's capability transfer.
Yeah.
And it diversifies them completely away from the price of a barrel of oil. If the world stops using oil but keeps using AI, SLB still has a massive business.
So while we're looking at these futuristic pivots, AI agents, geothermal servers, there was one thing in the notes that felt like a blast from the past. A sleeper hit, as one analyst called it.
Ah, yes.
Venezuela.
The geopolitical wildcard.
I feel like Venezuela has been a no-go zone for Western corporations for a decade. Sanctions, instability.
Infrastructure collapse, yeah.
Why is SLB even talking about it?
Because they never left. This is the last man standing theory. While almost every other major Western service company pulled out, SLB kept a footprint. They still have over 1,000 employees on the ground.
1,000. That is a massive payroll for a market that has been essentially dormant for Western profit.
It is. But think about the upside. Venezuela still has the largest proven oil reserves in the world. The infrastructure has crumbled, but the oil is there. If the geopolitical winds shift, and we know the U.S. creates licensing exceptions when it needs heavy crude.
Then SLB is the only major service company ready to go on day one.
Exactly. Everyone else has to hire, ship equipment, find housing, learn the politics. SLB is already there drinking coffee in the local office.
It's a lottery ticket.
It creates an asymmetric upside. If nothing happens, they maintain the status quo. But if it opens up, they have a near monopoly on the reconstruction contracts for the first few years.
It's a bold bet on patience. So let's step back. We have the cash fortress, the digital margin expansion, the data center hypergrowth, the Venezuela lottery ticket. Let's look at the bank account. Does this all translate to actual cash?
It's a cash machine. In 2025, SLB generated $4.1 billion in free cash flow.
And that's not a one-off spike or anything.
No, that marks the third consecutive year they've topped $4 billion in free cash flow. Consistency is key, and they are committed to giving that back. They plan to return over $4 billion to shareholders in 2026 through buybacks and dividends.
I saw they bumped the dividend up 3.5% too.
They did, so you're getting growth in income. But here is the part that, well, the analysts are pointing out as the big opportunity. If they are printing cash, growing a billion-dollar AI business and dominating globally, why are they trading at roughly 12 times forward earnings?
Was that low for them?
Historically, it's a steal. Their average is around 24 times earnings. So right now, SLB is trading at nearly a 50% discount to its own history.
Why? Is the market just blind?
It's that cognitive dissonance again. The algorithms, the generalist investors, they see oil services and assign a low multiple because the narrative is that oil is dying. They're not yet pricing in the sticky digital revenue or the explosive growth in data centers.
They're pricing it like a cyclical contractor, not a tech platform.
Exactly. A tech company with these kinds of AI growth numbers and margins would trade at 30 or 40 times earnings. SLB is trading at 12. That valuation gap is the opportunity.
So the bet is on a re-rating. You don't even need earnings to grow massively. You just need the perception to change, and the stock price could double just to get back to average.
That's the thesis.
Yeah.
If SLB can convince the market that they are a tech alpha, a technology company that just happens to work in energy, that multiple should expand.
So to wrap this all up, how do we synthesize these moving parts? It feels like they're trying to be two completely different companies at the same time.
They're executing what I call a strategic hedge. Think of it as side A and side B. Side A is the core. International gas, deep water, the Champion X assets. That protects the downside. It generates the massive cash flow.
And side B is the moonshot.
Side B is the growth engine, Agentic AI, Lumi, data centers, geothermal. That is designed to capture the future and make sure the company survives the energy transition.
It's like they're using the old world to pay for the new world.
That's it. As one of the reports quoted, the strategy is risk-defined, portfolio protected. They aren't betting the farm on one or the other, they're integrating them.
It leaves us with a pretty provocative question for anyone listening. We're used to drawing hard lines between energy and tech.
Yeah, different buckets.
But looking at SLB with its AI agents running drilling rigs and its geothermal plants powering data centers,
Yeah.
is there really a difference anymore?
Is SLB an energy company using tech to survive? Or is it becoming a tech company that just found the world's biggest sandbox, the Earth itself, to play in?
That line is blurring every single day. And I think for the investor or just the observer, spotting that blur before the rest of the market does, well, that's usually where the money is.
I'll definitely be watching those data center margins a lot closer next quarter.
Same here. I will never look at a drilling rig or a server farm the same way again. Thanks for joining us for this deep dive into the rewiring of an industrial giant.
A pleasure as always.
And thank you for listening. Keep looking for those disconnects, keep asking questions, and we'll see you on the next deep dive.